Gold is trading near record levels, central banks continue to accumulate the metal, and some of the world's largest gold miners are generating billions of dollars in free cash flow. Yet something about the market does not add up. The metal is expensive, but the companies producing it are still being valued by investors as if the good news has not fully arrived. And if that gap continues, it could become one of the most interesting valuation stories in the gold market. Look at the numbers. Newmont reported $2.2 billion of free cash flow in the second quarter of 2026 and ended the quarter with approximately $3.4 billion of net cash. Agnico Eagle reported roughly $1.34 billion in free cash flow for the same quarter. These are not speculative exploration companies hoping to discover an economic deposit years from now. These are major producers already operating large mines and converting elevated gold prices into substantial cash generation. The figures are based on the company's latest reported quarterly results and are therefore verified against their published disclosures. So why aren't their stock prices simply following gold higher? I'm Alex James, independent gold, silver, and economy analyst at Macroeconomic, and today I want to examine that disconnect without assuming that cheap automatically means buy, because that is one of the biggest mistakes investors can make. A stock can look inexpensive and remain inexpensive for years. The real question is whether the market is mispricing improving fundamentals, or whether there is a legitimate reason for the discount. And gold miners give us a fascinating case study. The first thing to understand is that a mining company is not simply a leveraged version of gold. Yes, the gold price is critically important, but the economics of a miner depend on the spread between what it receives for an ounce and what it costs to produce that ounce. That production cost is commonly measured using all-in sustaining costs, or AISC. Imagine a miner producing gold at an AISC of $1,500 per ounce while selling that gold for $4,400. The difference is enormous. Now imagine the gold price rises while production costs remain controlled. The company's operating economics can improve dramatically even without producing a single additional ounce. That is the part of the current gold mining story that deserves attention. Gold itself has spent much of 2026 at historically elevated levels, but mining costs have not risen one for one with the metal. That creates operating leverage. When the selling price increases faster than the cost base, every additional dollar in gold can have a disproportionately large impact on margins. This is why gold miners can behave very differently from physical gold. If gold rises 10%, a producer's revenue does not merely rise by 10% in economic terms. If its costs are relatively fixed, the increase flows disproportionately into operating profit and cash generation. The same leverage works in reverse when gold falls. That is the attraction, but it is also the danger. A mine has costs, employees, equipment, energy requirements, taxes, royalties, capital expenditure, political exposure, environmental obligations, and geological risk. Gold itself does not have to worry about a government changing the tax regime at a particular mine. A mining company does. So when investors compare physical gold with mining stocks, they are not choosing between two identical versions of the same asset. They are choosing between the metal and a business that produces the metal. And right now, the interesting question is whether investors are assigning enough value to the cash that these businesses are generating. Newmont's $2.2 billion quarterly free cash flow is a particularly important example because free cash flow is what remains after the company has funded its operating requirements and capital spending. It is much more useful for understanding shareholder economics than simply looking at revenue. Agnico Eagle's approximately $1.34 billion quarterly free cash flow tells a similar story from another major producer. The market is therefore facing an unusual setup. Gold prices are extremely high, major producers are generating substantial cash, and yet investor enthusiasm for the mining sector has not risen proportionally. So what explains that disconnect? The answer starts with history. Gold mining investors remember what happened during the previous major mining boom. Companies expanded aggressively, paid high prices for acquisitions, approved expensive projects, and allowed costs to rise. In other words, higher gold prices did not always translate into higher shareholder returns. That experience created something that still exists today: distrust. Investors learned that a rising gold price does not automatically mean management will allocate capital intelligently. And that historical memory may be one of the biggest reasons the market is demanding evidence before rewarding today's miners with higher valuations. But there is another factor that could matter even more. The market has changed dramatically. Capital is concentrated in a relatively small number of large technology and growth companies, while traditional commodity sectors often receive far less attention. That means the gold mining sector may not need dramatically better earnings to outperform. It may simply need investors to start believing that today's cash flows are durable. And that is where this story becomes much more interesting. Because if gold remains elevated, production costs stay under control, balance sheets remain strong, and management teams continue returning capital rather than destroying it, the market may eventually be forced to reconsider how much these companies are actually worth. The question is whether that revaluation has already started or whether investors are still waiting for proof. But now we need to separate the headline from the economics, because this is where the gold miner story becomes much more interesting. A miner does not make money simply because gold is trading at a high price. It makes money when the price it receives for gold rises faster than the cost of producing that gold. And right now, that spread is producing some extraordinary cash flow numbers. Take Newmont. Its second quarter 2026 results showed record quarterly free cash flow of approximately $2.2 billion, with gold production of about 1.3 million ounces. The company's reported numbers are verified against its own quarterly disclosure. Agnico Eagle tells a similar story from a different part of the industry. The company reported record second quarter free cash flow of approximately $1.335 billion and record shareholder returns of $625 million. Its quarterly gold production was approximately 856,000 ounces. Those figures come from Agnico Eagle's published second quarter results. Now think about what that means economically. When gold was trading at much lower prices, miners had to work much harder to generate the same amount of free cash. Today, with gold prices dramatically higher, every ounce produced can generate substantially more revenue provided operating costs remain controlled. That is operating leverage. And it is one of the most important concepts investors need to understand before looking at a mining stock. Suppose a company produces an ounce of gold for $1,600 and sells it for $4,400. The difference is $2,800 before considering the company's other financial obligations and adjustments. If gold rises another $200 while that cost stays broadly stable, the company does not need to spend $200 more to produce the ounce. Much of that additional revenue can flow toward operating profit and cash generation, but this is exactly where the market becomes skeptical. Investors have seen this movie before. During previous gold booms, miners sometimes responded to rising gold prices by increasing capital expenditure, buying assets at expensive valuations, approving marginal projects, and expanding production without sufficient discipline. Eventually, costs increased and shareholder returns suffered. That history matters because today's investors are not valuing these companies purely on the current gold price. They are also asking a much harder question: can management keep these margins? That is why all-in sustaining cost, or AISC, matters so much. AISC attempts to capture the broader ongoing cost of sustaining gold production, rather than looking only at the direct cost of extracting an ounce. It includes operating costs and other sustaining expenditures needed to maintain the business. If gold is $4,400 and a company's AISC is $1,600, the economics look very different from a company producing at $2,500. And this is where the sector separates into winners and losers. A low-cost producer has more protection if gold falls. A high-cost producer has less room for error. That is why I would not look at the gold mining sector as one single trade. Agnico Eagle, Newmont, Barrick, and smaller producers can all respond differently because their mines, jurisdictions, production profiles, capital requirements, and balance sheets are different. Barrick is a perfect example of why investors need to look beneath the gold price headline. Its second quarter results showed earnings of approximately $1.22 billion, helped by higher gold prices, but Reuters reported that its all-in sustaining costs increased 11% to approximately $1,866 per ounce. Its gold production was around 796,000 ounces. That is important. Gold prices can be near record levels while costs are also rising. So the correct question is not simply, is gold going up? The better question is the gap between gold prices and mining costs getting wider or narrower? If gold rises while AISC stays controlled, margins expand. If gold rises but AISC rises almost as quickly, the benefit to shareholders is much smaller. And if gold falls while costs remain high, the downside can become significant. This is why the current environment is so unusual. Several major producers are generating enormous amounts of cash, while investors remain highly sensitive to whether those cash flows can continue. Newmont is particularly interesting because its second quarter free cash flow was a company record, while management also maintained its broader production outlook. The company has therefore given investors evidence that high gold prices are translating into real cash rather than simply accounting gains. Agnico Eagle has provided another piece of evidence. Its record free cash flow was accompanied by record shareholder returns, showing that at least some producers are now using the stronger gold price environment to return capital rather than simply chasing production growth. And that takes us directly to the valuation question. If these businesses are generating billions in cash, why should their stocks remain valued at relatively modest earnings multiples? The answer is that the market is not only valuing today's earnings, it is trying to estimate tomorrow's earnings. Investors know that gold prices can fall. They know energy costs can rise. They know governments can change tax and royalty structures. They know mines eventually deplete. And they know management teams can destroy value through acquisitions. In other words, the market is applying a risk discount. The question is whether that discount is now too large. Because if gold remains structurally strong, central bank demand remains supportive, and major miners continue converting high gold prices into free cash flow without repeating the capital allocation mistakes of previous cycles, then the market has a problem. At some point, investors have to decide whether these cash flows are temporary or whether they represent a new earnings regime for the industry. And that is where the valuation gap becomes potentially explosive. But before calling this an obvious opportunity, we need to understand why the market has remained so skeptical in the first place, because the risks are real. A mine can experience a production problem, costs can rise, a project can be delayed, a government can change the rules, a company can overpay for an acquisition. And if gold itself falls sharply, the operating leverage that makes miners attractive on the upside can work against shareholders just as aggressively on the downside. So the question isn't whether gold miners are cheap. The real question is whether they are cheap for a reason or cheap because the market has not yet fully recognized how much cash these companies can generate at today's gold prices. And that is the valuation disconnect we need to investigate next. The valuation gap becomes much easier to understand once you stop looking at gold miners as simple proxies for the metal. The market is not saying that gold is weak. In fact, the opposite is happening. The market is asking whether today's exceptionally strong gold prices can remain high long enough to justify permanently higher valuations for mining companies. That is a very different question, and it explains why a miner can generate record cash while its stock still trades at a relatively modest multiple. The first reason is history. Gold miners have a long memory in the investment community, and not a particularly good one. During the previous major mining cycle, companies responded to higher gold prices with aggressive expansion. They bought competitors, approved large development projects, increased capital spending, and in some cases prioritized production growth over shareholder returns. The result was painful. Gold could rise while mining stocks failed to deliver comparable returns because the companies were effectively giving back the benefit through higher costs and poor capital allocation. Investors learned that a higher gold price does not automatically create a higher quality mining business. That lesson is still embedded in valuations today. When an investor looks at Newmont or Agnico Eagle, they are not only asking what the company earns at today's gold price. They are asking what management will do with those earnings if gold remains elevated for another 3, 5, or 10 years. Will the money go toward debt reduction? Will it go toward dividends and buybacks? Will management invest only in high-return projects? Or will executives become too optimistic and start paying enormous prices for acquisitions? That last question is particularly important because mining is a depletion business. Every mine has a finite resource. Eventually, production declines unless the company replaces those ounces through exploration, development, or acquisitions. This creates a permanent temptation for management. When gold prices are high and cash is abundant, executives can convince themselves that paying a premium for another mining asset is justified because future gold prices will remain high. That is exactly the kind of behavior investors are trying to avoid this time. And this is why the current cycle is different in one important respect. Investors are demanding capital discipline. Cash generation is getting more attention than production growth. That shift matters enormously. If a miner can produce roughly the same amount of gold while generating substantially more free cash flow, shareholders do not necessarily need the company to become dramatically larger. They can benefit simply from the company becoming more profitable. And this is where the major producers have an opportunity to change the market's perception. Newmont's second quarter results showed $2.2 billion in free cash flow. Agnico Eagle generated approximately $1.335 billion. Those are substantial amounts of cash for companies operating in a sector that investors historically viewed as capital-intensive and unpredictable. But the market still has another reason to hesitate: ownership. Gold miners remain a relatively small part of most diversified equity portfolios. Investors who want gold exposure often choose physical gold, ETFs holding bullion, futures, or other instruments instead of mining shares. That means money flowing into gold does not automatically flow into miners. And this distinction is extremely important. A central bank buying gold does not need to buy a single mining stock. An individual investor purchasing a gold bar does not create direct demand for Newmont shares. A sovereign institution accumulating bullion can support the gold price without changing the valuation multiple assigned to a mining company. So gold can rise while miners lag. That sounds strange until you understand the ownership structure. The gold market and the gold equity market are connected, but they are not the same market. And then there is the biggest competing narrative in global equities: technology and artificial intelligence. Over the past several years, enormous amounts of investor capital have concentrated in mega-cap technology, semiconductors, cloud infrastructure, and AI-related companies. These businesses offer something mining companies cannot easily offer: visible secular growth without the geological depletion problem. An AI infrastructure company can theoretically sell more computing capacity every year without having to discover another mine. A gold mine cannot. That difference affects valuation. Investors often pay higher multiples for businesses they believe can compound revenue and earnings for decades. Mining companies are generally valued more conservatively because their assets decline over time and require continual capital investment. But there is another side to this. When gold is at historically elevated prices, a miner does not necessarily need explosive production growth to generate attractive returns. If production remains stable, costs remain controlled, and the gold price stays high, free cash flow can remain extremely strong. That can support dividends, buybacks, debt reduction, and acquisitions if management remains disciplined. This is where the market may eventually be forced to reconsider the sector. But eventually is the key word. Cheap stocks can remain cheap. A low price-to-earnings ratio is not a catalyst by itself. The market needs a reason to change its expectations, and one of the clearest potential catalysts is sustained earnings growth. If the next several quarters continue showing strong free cash flow, stable or declining AISC, healthy balance sheets, and disciplined capital allocation, investors may begin to believe that this is not simply a temporary gold price spike. They may start treating the current cash generation as structural. That is when valuation multiples can expand. And that is the difference between a value trap and a genuine re-rating. A value trap is a company that looks cheap because the market correctly anticipates that earnings will deteriorate. A re-rating happens when earnings remain strong and investors gradually become willing to pay more for those earnings. For gold miners, the evidence we need to watch is therefore very specific. Are free cash flows staying strong? Are AISC figures remaining under control? Are balance sheets improving? Are companies returning capital to shareholders? And most importantly, are management teams resisting the temptation to repeat the mistakes of the previous mining cycle? If the answers remain positive, the valuation argument becomes stronger. But there is still one major risk sitting above the entire thesis: gold itself. Because miners may have stronger operating leverage than physical gold, but that leverage works in both directions. If gold falls sharply from current levels, mining stocks could fall much faster. That means the market may be discounting something very simple. Gold prices are exceptionally high, and investors are not convinced that they will stay there. If that assumption changes, the valuation gap could close quickly. But if the assumption is wrong, if gold remains structurally supported by central bank demand, geopolitical uncertainty, fiscal concerns, and investor demand, then the miners could eventually look very different from the way the market values them today. And that brings us to the central question: what would actually force investors to recognize this sector? The answer is not another dramatic gold headline. It is a combination of sustained cash flow, disciplined management, stable costs, and capital moving back into the sector. And if those pieces begin arriving together, the miners may not need gold to make another huge move. They may simply need investors to finally believe the earnings they are already seeing. So now we get to the part that matters most for anyone trying to decide whether this valuation gap is actually an opportunity or simply a trap. The numbers are attractive, But numbers alone do not create a re-rating. The market needs a catalyst. And for gold miners, I see several things that could begin closing the gap between what these companies earn and what investors are currently willing to pay for those earnings. The first catalyst is simple: gold itself. Everything starts there. If gold remains around historically elevated levels, miners have the potential to continue generating exceptional margins. But if gold falls sharply, the operating leverage works in reverse. That is why I would never analyze a mining stock without first looking at the gold price, real interest rates, the US dollar, and the broader macro environment. Gold has several structural supports, including central bank demand and continued investor interest in the metal as a hedge against monetary, fiscal, and geopolitical uncertainty. But structural support does not mean the price cannot correct. Gold can fall 10%, 15%, or more even inside a longer-term bullish trend. And when that happens, miners can fall harder. That is the first risk investors need to understand. The second catalyst is free cash flow. If Newmont continues producing billions of dollars of quarterly free cash flow, and if Agnico Eagle continues producing more than $1 billion per quarter, the market will eventually have to decide whether these numbers are temporary or sustainable. One quarter can be dismissed. 2 quarters can be called a strong cycle. Several years of strong cash generation becomes much harder to ignore. That is why the next earnings reports matter so much. I would be watching free cash flow more closely than headline revenue. Revenue can rise simply because gold prices are higher. Free cash flow tells us whether the company is actually converting those higher prices into money available after sustaining its operations and capital requirements. The third catalyst is AISC. This is probably the most important operating number in the entire mining sector. If gold remains around $4,000 plus while AISC stays around the current cost levels, margins remain enormous. But if costs begin climbing rapidly, the investment thesis changes. Mining is an inflation-sensitive business. Energy, labor, equipment, construction, transportation, and services can all become more expensive. If those costs accelerate, some of the benefit from a higher gold price disappears. So I would not celebrate a rising gold price without checking the cost side. Gold at $4,500 with AISC rising aggressively is a very different investment environment from gold at $4,500 with AISC remaining disciplined. The fourth catalyst is capital allocation. This is where I think the current generation of gold miners has the opportunity to separate itself from the previous cycle. Investors do not necessarily want miners to become bigger at any cost. They want them to become better businesses. That means reducing debt, maintaining strong balance sheets, returning capital through dividends or buybacks when appropriate, and investing only in projects that can generate attractive returns. Agnico Eagle's recent results are relevant here because the company reported record quarterly shareholder returns alongside its strong free cash flow. That is the kind of behavior that can gradually rebuild investor confidence. Newmont is also using its stronger cash generation to strengthen its financial position and return capital while maintaining investment in the portfolio. If that discipline continues across the sector, the old argument that miners always destroy the value created by higher gold prices becomes harder to defend. And that could be the beginning of a valuation re-rating. But there is another catalyst that gets far less attention: capital flows. Think about what happens when investors finally decide they want gold exposure through equities rather than only through physical metal. They need to buy mining stocks, they need to buy mining ETFs, they need to allocate money to the sector. And because the sector has been relatively under-owned, even a modest increase in institutional allocation could have an outsized impact on share prices. If this analysis gave you a different perspective on gold miners, subscribe to Macro Bullion for independent breakdowns of gold, silver, the economy, and the macro forces moving these markets. And tell me in the comments, are gold miners genuinely undervalued, or is the market correctly pricing in the risks? Do your own research, DYOR, and remember that this is educational analysis, not personalized financial advice. Because in this market, the biggest opportunity is often not where everyone is looking. Sometimes it is hiding in the gap between the price of the commodity and the value of the companies producing it.